This will create a global economic crisis. What am I referring to? I'm talking about the dollar skyrocketing higher over the past few weeks. It got up to over 107 on the DXY yesterday. It's already crushed economies like Sri Lanka, Turkey, Argentina, Ecuador. And if the dollar continues to go higher against other currencies, we could see countries collapsing like Japan and even countries in Western Europe, to the point where we have this global economic crisis that could eventually impact the United States. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over what the basic problem is. Let's start by going all the way back to the GFC, something we all know well. Starts off with the average Joe. He takes out a loan to buy, let's say, a rental property, and his monthly mortgage payment is $1,000 a month. Let's say his other expenses about $400, but he gets $1,500 in rent, so he's got positive cash flow of about $100 a month. Not bad. But let's say that Joe has an adjustable rate mortgage. We all remember these. So instead of his monthly payment being $1,000, now it's $1,200. He still has the same $400 in expenses, the same rent coming in $1,500, but instead of being $100 positive cash flow at the end of the month, now he has negative cash flow. He has to come out of pocket to cover the expenses for the rental property he just purchased. So now let's move on to the average Joe. Not as happy as he was at the beginning. You can tell he's got a big frown on his face. So he looks at his balance sheet and says, oh my gosh, I've got to come out of pocket $100 a month, and it could get worse if interest rates go even higher and my loan adjusts again. So he's got these dollars as assets on his balance sheet, but pretty soon he runs out of dollars. But he still has that loan and that monthly payment as a liability. You guys know how this story ends. Joe goes bankrupt because he doesn't have any money left to cover the costs of the rental property that he purchased because the interest rates kept going up and up and up. In other words, the burden of his debt continued to increase until he went bust and he had to give the house back to the bank. Then, if enough people had these adjustable rate mortgages, like the average Joe, all of these loans go bad, and this creates a systemic risk, not only for the banking system, but the domestic economy and potentially the global economy, leading, again, to a global economic crisis. But now what we're dealing with, we'll say we go from the GFC to what I'm calling the DFC, the dollar financial crisis. And with the dollar financial crisis, it's very similar to what happened with the GFC and adjustable rate mortgages on homes. But now it's about 1,000 times worse. And I might be understating that. Because now these rates, if you will, adjust daily. And when there are dollars that are taken off the balance sheet to make the higher loan payments, this exacerbates the problem. By paying the loans with the dollars on Joe's balance sheet, it makes the debt burden even higher. And I'll explain this in one moment. But let's go over to not the average Joe, oh no, but his cousin down in Argentina, the average Jose. And the average Jose starts a widget maker. We'll call it Widget XYZ Corporation down in Argentina, and they deal in pesos. But a lot of Jose's input costs are denominated in dollars. So he had to go out there and take a dollar-denominated loan. We'll say his monthly payments for this dollar-denominated loan are $1 million a month. Okay, and let's just assume for a moment that we start off with a 1-to-1 relationship between the peso and the dollar. Now let's go through what happens to Jose, and you'll see it's the exact same thing that happened to Joe, but on a much, much larger scale. So he's got a $1 million a month payment, and this is denominated in dollars, but right now we've got a 1-to-1 relationship. We'll say his expenses about 400,000 pesos per month, his income about 1.5 million pesos per month. So in this example, he is netting $100,000 or pesos per month. Pretty easy math. But now let's say the dollar goes higher against the peso. And this is what we have seen to an extreme over the past few months. And like I said at the beginning of the video, the dollar now is at 107 on the DXY. For most of you, that might not sound like a big deal, but trust me, if the dollar goes up 10, 20% relative to your local currency, this could be the catalyst that brings down the entire house of cards. Let's keep moving on with the example. So now the dollar is worth 1.2 pesos. So in peso terms, now the debt has become more of a financial burden. Now our peso amount of the loan per month, or our monthly loan payment, is 1.2 million. Our expenses are still 400,000. Our income, revenue, still 1.5 million. So now we're at a loss of 100,000. Instead of here, we're at a gain of 100,000. It's the exact same thing that happened to the average Joe. But what's different is not only does Jose go bust, but then he has to lay off all of his employees, which now don't have any purchasing power to put a roof over their head, buy food, etc. And if Jose does have pesos on his balance sheet, just like Joe had dollars, he's going to sell those pesos to buy dollars to make that monthly loan payment, right? But what is he doing? He's increasing the supply of pesos and increasing the demand for dollars, which, like we said here, makes the dollar go higher against the peso and exacerbates this problem. In other words, it makes the loss that he has every single month even greater by using the peso cash flow or the peso assets that he had on his balance sheet to make the previous month's dollar-denominated loan payment. But unfortunately, our story doesn't end there. It gets a lot worse for the average Jose down in Argentina. Just like we saw with the GFC, the unemployment rate spiked higher, meaning the average Joe wouldn't have as many people there to rent his property. So maybe it goes vacant to where his income goes from $1,500 a month down to zero. All right, well, let's say that we have this global economic crisis where the dollar going up and up and up is reducing economic activity. Well, that means that if the average Jose was collecting dollars, let's say part of his revenue was denominated in dollars because he is exporting his widget to other countries, and those other countries are paying him dollars for the widgets that he is sending to them or selling them. Okay, well, so let's just say that he has $1.5 million coming in, and that loan payment is $1 million per month. And again, expenses are 400,000 pesos. But what happens when the global economy slows down? Now his income or his revenue goes from 1.5 million down to 1.3 million. So even if he is making dollars, he's making far fewer dollars, which takes him right back into the same position he was before, where every single month he is losing money. And as he loses more and more money, he lays off more and more people. And this happens globally. Therefore, the amount of customers he has shrinks and shrinks and shrinks. And then so does his revenue, therefore putting him in a worse and worse position every single month. So the main takeaway from step number 1 is we had a GFC back in 2008, let's call it. But if the dollar continues to go higher and higher and higher against other currencies, we will go into a DFC, a dollar financial crisis, for the exact same reasons. The bottom line is, as the dollar goes higher, the debt burden increases for all of these global entities and global economies, just like it did for the average Joe during the last global financial crisis. The problem is that the DFC is global. This was specific to real estate. So my point is the dollar financial crisis will be exponentially worse than the global financial crisis we saw in 2008. Step number 2. Unfortunately, it gets much, much worse for our friend, the average Jose. Why? Because commodities are settled in dollars. So let's think about this. If Jose was in an Argentina in an alternate universe, let's say, that didn't have any dollar-denominated debt, like we used in this example in step number 1, they still have big problems. Why? Because most of their trading partners are in the situation that we outlined in step number 1. So let's think about this. In a normally functioning global economy, let's say that we have $3 coming in to Argentina, represented by this black square. And this central bank, we'll say the Argentinian central bank, not sure what they call it, but we'll just say this represents the entire banking system. So if the global economy was functioning in a healthy way, again, we'd have $3 coming in. All right, well, what does Jose do with those dollars? Well, a lot of them he's got to give to the bank or the central bank to get pesos, because his expenses, his payroll, as an example, denominated in pesos. And then alternatively, if Jose needs to buy some commodities, let's say wheat, corn, or oil, he has to take some of his pesos, give them to the banking system to get those dollars in return so he can buy those inputs. Because again, those commodities are settled in dollars, not pesos. So in other words, if you don't have the dollars to buy the stuff, you ain't getting the stuff, no matter how many pesos you have. So this puts Jose, in the country of Argentina in this case, in a very difficult position if their trading partners start going into a recession, because they're bringing in fewer dollars into the country. So let's think about this in terms of the balance sheet of the banking system. We have assets on the left, liabilities on the right. If they have all these dollars coming in because the global economy is functioning on all 8 cylinders, then they're going to have these $3 on the asset side of their balance sheet. They're going to have a lot more than just dollars on the balance sheet. So keep in mind, this is only for the sake of this example. Then the liabilities, most likely peso bank reserves or peso deposits. So if they have fewer dollars coming in, then we go from their balance sheet having $3 to their balance sheet only having $1. Okay, but let's think about this. It takes us straight into a doom loop. We'll call it the peso dollar doom loop. That if the country is bringing in fewer dollars, well, they have to have those dollars to get the stuff they need. Therefore, they're going to have to print pesos to buy dollars. This increases the supply of pesos and increases the demand for dollars, just like we talked about over here. If the dollar continues to go higher, then we look at this phenomenon in aggregate total across the entire globe. We see that this is going to reduce the velocity of dollars going from one country to the next, which just exacerbates this doom loop. And let's not forget, this stuff Argentina needs is settled in dollars. So let's assume that when our example began and they had $3 coming in because the global economy was running on all 8 cylinders, that 1 peso bought this amount of goods. Well, now it costs them 2 pesos to buy the same amount of goods, which puts them into a deeper recession than they were already in. Think about the United States right now, how we see the CPI at 8.6%. Well, it makes you realize that the demand for food, energy, shelter is very inelastic. Therefore, people, if they have to, are going to prioritize food, energy, shelter, which means they're going to take money away from other things that they would have bought. One man's spending is another man's income. So if they're taking money away from all the things they really don't need to pay for the things they really do need, then this creates an economic recession within the country, which has a systemic effect on all the other countries because there's fewer dollars going out of Argentina to XYZ country or 1, 2, 3 country because their purchasing power has been diminished. And it's not just one man's spending is another man's income, but one country's spending is another country's income. So if we go into this scenario, meaning the dollar keeps going up and up and up and up, causing these recessions in all of these countries, reducing their purchasing power, and it's exacerbated by them having to print pesos to buy the dollars they need to import the commodities in the first place. It takes us right back to this situation that we outlined in step number 1, where there are fewer dollars going into we'll say the original Jose to pay off his dollar-denominated debt. You have greater defaults. This puts pressure on the banking system, which means dollar liquidity goes down. The less dollar liquidity we have, meaning the less access to dollar-denominated credit these corporations have, the greater demand for the existing dollars that are circulating within the system. And it takes us right back to this dollar doom loop. And instead of happening just at a domestic level in Argentina, it happens at a global level, taking the dollar maybe from 107 to 110 to 115 to 118, where the central planners, the countries themselves, the central banks, would have to come together and figure out some sort of solution before the whole entire global economy implodes. Whoa, time out. I know that might have been a little tough for a lot of you to follow, so let me describe it in a little bit different way, so hopefully you can connect the dots and make sense of this all. I know it gets very complex. So let's go over to the far side of the whiteboard and start with a simple question. We've got to understand that we live or we have a debt-based monetary system. So the way dollars or currency units are created is by banks lending them into existence. But there's a catch. If the banking system creates $10 worth of loans, there's actually $20 worth of debt, let's say, because you've got to add interest. So I know that the math isn't perfect here, but I'm just using this as an example. So again, if the banking system creates $10 of currency units by lending them into existence, there's more debt than currency available to pay the debt when you include the rate of interest. Now, a lot of people would come to the conclusion that, oh my gosh, this means that the system has to fail. That isn't entirely true. Because if you have velocity of this $10 or of these $10 that are circulating within the system, if velocity is high enough, you can pay off $20 worth of total debt, including interest, with only $10 in the system. But what we're talking about in these examples is economic activity being reduced. And it can be reduced many ways. One would be global lockdowns. How can we assume that locking everyone in a cage and not allowing them to produce goods and services is going to lead to anything other then lower velocity. And that's just one example of central planning. Another would be sanctions on Russia. That's going to decrease the velocity. And I could go down the list of these things that the governments have screwed up that create these unintended consequences. Or maybe those unintended consequences aren't so unintended. I'll let you be the judge. But the bottom line here is when economic activity decreases, so does the velocity. And you get into a position where if the velocity isn't high enough, like we said earlier, there aren't enough currency units to service the debt. So then what happens, it takes us right into this loop where there are more currency units created of XYZ currency, call it pesos, to buy the existing dollars that are out there. Therefore, the demand for the dollars increases significantly if the velocity goes down. In other words, if economic activity globally declines. And what makes the problem even worse is as the velocity goes down, there isn't enough dollars to service the debt, but there also isn't enough dollars to buy commodities like food and energy. And we know by studying history that if people don't have access to the necessities, especially food, that's when they go out to the streets with the torches and the pitchforks. In other words, social unrest. And if the dollar continues to go higher, we're not only going to see this social unrest in countries like Ecuador, like Sri Lanka, like Turkey, but we're also going to see it spread to other countries like Japan, like Western Europe, and possibly even the United States. And I know many of you right about now are probably scratching your head and say, well, wait a minute, George, how can the United States have a problem when they could just print any of the dollars they need? Well, you're right. The United States can print the money to buy the stuff. But unfortunately, we don't make any of the stuff. So if all of these corporations, like the widget maker that Jose has, are going bust, that means that the next time you go to Walmart, Target, Home Depot, there isn't going to be any stuff available for you to buy with your dollars. Also, we produce a lot of commodities here in the United States, but we don't produce all the commodities we consume. We import a lot, especially energy, when it comes to different grades of oil than we produce right here in the United States. So if the whole global economy stops producing stuff, that means that we in the United States will have a lot less stuff, shortages, regardless of how many dollars that we have in our bank account or how many dollars the government and the Federal Reserve can print. My point is if the dollar continues to go higher and higher and higher, it's not just a problem for all those other countries. We'll let them deal with it. Not even close. This is a huge problem, not only for the globe, but for Americans and the United States. Step number 3. So what are the solutions? How do we get the dollar back down to a level to where it is manageable for the global economy? I know this hasn't been the most uplifting video I've ever done, so I definitely want to go over some solutions. But trust me, I could have got even more doom and gloom if I would have talked about the amount of derivatives that are actually built or created on top of this global dollar-denominated debt. Let's just use as an example the GFC again. Maybe there was $5 trillion or so in mortgage-backed securities or mortgages that all these derivatives like CDOs and credit default swaps were built on. Well, now we're talking about probably $200 trillion worth of debt that is the foundation or the base for all of these other or very similar types of derivatives that we had back during the GFC. So let that one sink in for a moment. That's a completely separate video in and of itself. But getting back to the solutions here, what can be done? First, the Fed could just print an epic amount of dollars, and in the United States, we could somehow just produce a lot less than we're already producing. And I know this wouldn't be ideal for the US economy, but I'm strictly trying to think through how we could get the dollar down if we really needed to. We, meaning the central planners, the politicians, etc. So in this case, the Fed would just pretty much print money, give it to the average Joe, and the average Joe would take those dollars and give it to Jose. The average Joe would just have to produce less than we already produce, and that in and of itself would be a challenge because the U.S. doesn't produce anything. But just hypothetically, we don't produce, or we produce even less. We offshore even more, so more stuff comes in, meaning our trade deficit increases even more. More dollars go out and circulate in the global economy. Okay, and I'm not saying these are perfect solutions. I'm just trying to think through everything that we could do to put downward pressure on the dollar. Swap lines. Now, most of you have heard of swap lines going back to 2020. This is pretty much where the Fed just puts dollars in the account of XYZ central bank. We'll call it Argentinian central bank. And the Argentinian central bank gives the Fed pesos, puts it in their account, and we just have this swap, dollars for pesos at a specific interest rate. And then the central bank has dollars to go ahead and give to Jose for his pesos. Now, there is a catch here because the central bank doesn't go directly to Jose, so the banks are the intermediary, if you will. So in order to get those dollars to Jose, the banks have to lend them to him. And are the banks going to be willing to lend to anybody in the type of environment that we went over in steps 1 and 2? Probably not. Now, those banks could just swap dollars for pesos to give to Jose, but that would require his business to be making a profit, even in peso terms, to begin with. And with economic activity declining, with velocity slowing, that's going to be more and more difficult. So this is by no means a panacea. Next, we've got interest rate differential. Pretty easy. So if the Fed just drops rates down to 0 and all these other central banks just bump rates up to, let's say, 5%, then the dollar would most likely go down. This would put downward pressure on the dollar. But here you can already see the problem. One of our main issues is economic activity globally and velocity. Therefore, what's going to happen to economic activity outside the United States if the Bank of Japan bumps rates to 5%, or the ECB does the same thing? You're going to have the opposite of economic activity. You're going to have economic destruction to a massive degree. But let's think this through. If the dollar has downward pressure, if the Fed starts lowering rates and the other central banks start raising them, we're in the exact opposite environment right now as we speak. The Fed is actually raising rates even faster than these other central banks, therefore making the problem even worse. So let's take it to the next step. If we continue to see the CPI at high levels in the United States, this would prompt the Fed to take rates higher and higher and higher, which would do what? That would put upward pressure on the dollar, putting downward pressure on the global economies, increasing the probability that we have this dollar financial crisis or global economic crisis, whichever you prefer. So again, by no means a panacea, and right now we're actually doing the opposite. So number 4, we could have a booming global economy because all these banks in the Eurodollar system, if they see productive loans out there, they're going to create more and more and more dollars. So this is pretty simple. If we've got Jose that starts trading a lot, doing business with the average Joe, and the average Jose and the average Joe start doing a lot of business with their Asian cousin, we'll call him the average Ho, and the average Ho starts doing business with the average Jose, then we could have this velocity that we're talking about, this economic activity really increase. More dollars are being created, like we said, with the Eurodollar system. And this could also solve the problem. This could bring the dollar back down to a tolerable level. Number 5, we could have a Plaza Accord 2.0. Back in 1984, 85, if my memory serves me right, the United States met with countries like Japan and Germany. The dollar was extremely high. They needed to get it back down. So the central planners did this artificially. And this basically means the Fed goes out there, prints a massive, trillions and trillions amount of dollars, and just sells them into the global FX market to increase the supply. If the supply goes up that high, most likely the dollar comes down. Now, this gets very technical, and I'm not going to dive into that, but this is basically the gist of how they might do a Plaza Accord 2.0. They could do it in a different way, who knows? But the main takeaway is that the central planners would come together and artificially lower the value of the dollar, just like they did back in the 1980s. So then with the Plaza Accord 2.0, the question becomes, well, at what point will they need to step in and do something? And I can't answer that question for you. But what I can say is if we throw up a chart of the DXY right now, editor, go ahead and help me out with that one. We can see that we're at 106, 107. Now, I'm not a technician by any means, but I do understand just basic support and resistance levels. And it seems like if we break through, let's call it 109 or 110, that from a technical analysis standpoint, we could move all the way up to 118 very quickly. Would this create enough economic damage for the central planners to come in and try to, quote unquote, do something? I don't know. We'll have to see how it plays out. So the main takeaway from this entire video is we are moving into some unprecedented times. We're going to see a lot of uncertainty, and it's definitely going to be very tumultuous. So now is a great time to check out Rebel Capitalist Pro. It is the investment forum that I have with my partners Lynn Alden and Chris McIntosh, other pros Brent Johnson, Jason Hartman, Tony Greer, Patrick Seresna. And our objective is to help you navigate these tumultuous economic times to the best of our ability. So check it out right now at georgegammon.com/pro. I think you'll find this is one of the best ways to ensure that you are building wealth and thriving in this world of out-of-control central banks and big governments.